What are futures? Futures are financial derivative contracts that bind parties to buy or sell an asset at a specified future time and price. Regardless of the market price at the date of expiration, the buyer or seller must buy or sell the underlying asset at the agreed-upon price. Physical commodities and financial instruments are examples of underlying assets. Futures contracts are standardized to make trading on a futures market easier and specify the quantity of the underlying asset. Futures can be utilized for trading speculation or hedging. Understanding futures. The price of the underlying asset or commodity can be fixed through the use of futures, often known as futures contracts. These contracts have set pricing that are known up front as well as expiration dates. Futures are distinguished by their month of expiration. For instance, a gold futures contract for December expires in December. Futures refers to the entire asset class as used by traders and investors. However, there are other futures contract types that can be traded, including commodity futures with underlying materials including natural gas, corn, wheat, and crude oil, stock index futures with the S&P 500 index as its underlying asset, futures contracts on currencies, such as those for the euro and the pound sterling, futures contracts for gold and silver, bonds and other financial assets in the United States Treasury futures. American-style options contracts provide the holder the freedom to buy or sell the underlying asset at any time prior to the contract's expiration date. The only time you can exercise a European option is at expiration, but you are not required to do so. On the other hand, the buyer of a futures contract is required to take possession of the underlying commodity, or its equivalent in money, at the moment of expiration and not earlier. A futures contract's buyer is released from their commitment if they sell their holding before the contract expires. In this approach, a leverage holder's position closure before to the expiration date benefits buyers of both options and futures contracts. Pros: futures contracts allow investors to make predictions about the course of an underlying asset's price. To guard against unfavorable price changes, businesses can hedge the price of the items they sell or the raw resources they use. Futures contracts may only need a tiny portion of the total contract value to be deposited with the broker. Cons: futures use leverage, so investors run the risk of losing more than their initial margin. A corporation that hedged its exposure can lose out on positive price fluctuations if it invests in a futures contract. Gains can be accentuated but losses can also be, making margin a double-edged sword. Summary: futures are derivative financial contracts that obligate either the buyer or the seller to buy or sell a particular asset at a specific price and future date. An investor can speculatively bet on the price of a financial product or commodity by using futures contracts. Futures are used to protect against losses from unfavorable price movements by hedging the price movement of the underlying asset. Hedging involves taking a position that is the opposite of the one you hold with the underlying asset. If you lose money on the underlying asset, your gain on the futures contract can help to offset that loss. The prices of futures contracts settle at the conclusion of each trading session on a futures market. Thanks for watching. Don't forget to subscribe.